In this week's video, we'll review a wide range of short and long-term charts to help us answer the question, is the stock market due for a change in character? We'll kick off the video by revisiting some bullet points that we covered on January 8th. Bullet point number 2, correction in Q1 of this year would not be shocking. However, the 1995 case says we shouldn't assume anything. You might be thinking 1995, that's ridiculous. Well, here's a data point from the end of 2020, and it's still in play in early 2021. The last time the NASDAQ Volume Summation Index was this high, July 14th, 1995. Between point A and point B, we never get a reading that high. Thus, it might be helpful to know how the S&P 500 performed over the next year. Before we do that, if you know your stock market history, you know from January 1st, 1995 until July 14th, 1995, the date of our signal, the S&P 500 performed extremely well, and it might have been very, very easy on July 14th of 1995 to say we are overdue for a 6 to 10% pullback. Is that what happened? No, we had a very, very shallow pullback. The maximum drawdown from the date of the signal, July 14th, 1995, was less than 2% on a closing basis. And the gain from point A, July 14th, 1995, to point B up here in calendar year 1996 was 21.17%, which helps us keep an open mind about a wide range of outcomes on all time frames. Keeping an open mind about a pullback in Q1 of 2021, not particularly hard to do. This is a little bit more difficult. And if you don't know your stock market history, you may be thinking, well, eventually this gain must have been given back. That was not the case. From July 14th, 1995 until the spring of the year 2000, this is where the dot-com bubble bursts, the S&P 500 never looked back. If we open up the Settings tab for human nature, we will find that the default setting, relative to the stock market, is a high degree of skepticism. Thus, how would it even be within the realm of possibility to see something like this over the next 3 to 5 years? We all know the stock market was incredibly strong in January of 2020, and then COVID appeared on the scene in the United States. Thus, it's very, very possible that business conditions and earnings will improve significantly over the next 6 to 24 months. And we're already starting from a relatively strong base in terms of manufacturing. This data was published on January 22nd, 2021. And if we were to see something like this, a move from the left side of the screen to the right side of the screen, we would expect companies to be pretty confident about earnings going forward, and that is exactly what we have. January 19th, 2021, FactSet, record high number of S&P 500 companies issuing positive earnings per share guidance for Q4 of 2021. How about stock market action? Is it aligning with the possibility of a shift from the left side of the screen to the right side of the screen? To answer that question, let's take a look at a subtle and recent move in market leadership. It's the NASDAQ Composite Index relative to the S&P 500. This chart is dated January 21st of 2021. We all know the NASDAQ was an incredibly strong leader off of the March low, and then it consolidated its gains for several months. If you're a stock market bear, you know what you want to see here? You want to see this chart on a relative basis roll over and break below this box. If you're a stock market bull, what do you want to see? Just the opposite. You want the prior leadership group to reassert that leadership. Right now, that's exactly what we have in front of us. This is the chart in front of us. This is a bullish breakout. This looks like a retest on a relative basis, and this looks like a higher high. hard to make an argument that this leans bearish for the next 12 to 24 months. Let's look at it a little bit more specifically in terms of the tech sector. This is the NASDAQ composite, the tech-heavy NASDAQ. It has a heavy weighting to technology, and then a handful of popular tech ETFs. And this black line here is the equal weight S&P 500 technology ETF. Notice from the March 23rd low to September 2nd, we have somewhat of a narrower rally with the equal weight lagging significantly and the NASDAQ Composite Index lagging. Since then, we've seen a change in character. This is broadening out. Now the equal weight tech is on top, the NASDAQ Composite Index second, and the prior leaders below. And that's exactly what we would expect to see when the market is expecting broader economic outcomes, broader favorable economic outcomes in the months ahead. Like everything we cover in these weekly videos, our statements are based on the chart in front of us. Is this subject to change? Could we get a false breakout? Absolutely, positively, yes, but that's not what we have in front of us today. We can even take it a step further. This is the equal weight here. If we add in semiconductors, they look even better. And since semiconductors are found in all sorts of consumer products, this also speaks to improving economic expectations. Now let's shift gears to the align with or contradict school of thought and see what we can learn. We covered two very interesting and enlightening charts on David Keller's final bar program this week. And now we're going to spend a few moments expanding on those concepts. Clients and regular viewers know that we've been looking at charts that peaked in January of 2018, all sorts of charts. QQQ, TLT, QQQ divided by gold, stocks versus bonds, stocks versus gold. And many times you have downward sloping trend lines, and what we're looking for is bullish breaks to the upside. Now, it would be fair to say at the end of October of 2020, this is the Global Dow that we're looking at, we would have to say that this chart contradicts the secular trend thesis for stocks in the United States. This is a discernible point below the high that was made before the pre-COVID plunge. At the end of October 2020, which is just a few short weeks ago, we are discernibly lower than the high that was made in the Global Dow in January of 2018. If we fast forward to January 21st, 2021, now we have a chart that aligns with the secular trend thesis in the United States. This is a sharp move where we exceeded the high from Q1 2020 and are clearly above the prior high of January 2018. Now let's focus on this solid blue line where my cursor is. That is right before the U.S. election. You might remember there was a sharp sell-off in equities in the United States before the U.S. election and then a sharp reversal. This low here coincides with the peak in the Global Dow that was made way back in 2007. What once acted as resistance may now act as support. Thus, between January of 2018 and the present day, the Global Dow has been trying to decide whether it wants to hold a bullish breakout above this level or if it wants to have more of a failed breakout look. And from a shorter term perspective, yes, the stock market is incredibly extended. From a longer term perspective, stock market globally has not really made a lot of progress. The Global Dow before the U.S. election was basically trading at the exact same level just a few short weeks ago as it was way back in 2007. This is not an index that is extended from a base. This is an index that is very, very close to a base and now looks like it's trying to move away from that base in a bullish manner. Also noteworthy that the Global Dow has broken out of this period of consolidation that goes back to the January 2018 high. This is relevant to all risk markets because we have a non-confirmation just a few short weeks ago. And this is a non-confirmation from a laggard. The Global Dow is not a leader, it's a laggard. What do we mean by that? If the Global Dow were a current leader, we would expect it to be breaking to new highs relative to the S&P 500 index. It's not what we have. The Global Dow peaked relative to the S&P 500 way back in 2007, 2008, and has basically been in a long-term downtrend since that time. And there have been numerous false starts. We need to be in global stocks. We need to be in global stocks. We need to be in global stocks. Global stocks are the place to be. Global stocks are the place to be. Is it possible that global stocks will be the place to be going forward? We know the answer. It's possible, but this chart has some work to do. We haven't even completed step one for a long-term trend change. And yes, even if the downtrend remains in place, we can see long periods of outperformance relative to the S&P 500. But in each case in a downtrend, it's eventually all given back and followed by a lower low. Global stocks have been, and they will continue to be, on our radar. And if this chart can get to the other side of the line and start making a series of higher highs, then the odds of allocating resources towards global stocks will increase. It would be unlikely that we would get a secular trend in U.S. stocks and have the Global Dow not come along for the ride. The break above this 2007 high here is similar to the breakout from the global leader, the S&P 500, that occurred in 2013. And this breakout is significant because in 2013 we also cleared the high from 2000. And the S&P 500 left a long-term consolidation box that began in 1996. We revisited that level at the low in 2009 and then exceeded these prior highs with the breakout in 2013. Thus, with the Global Dow in its present form, it's probably fair to say that that chart now looks more like the end of the beginning rather than the beginning of the end. Do we have any other recent data that aligns with that? Yes, this is the S&P 500 Small Cap Index, January 21st, 2021. We have data, and we're looking at all of it that goes back to 1995. Only two prior times as the rate of change moved from this line here to this line here, this line here to this line here. After the major low that occurred in October of 2002 in the S&P 500 index, and after the major low that occurred in the S&P 500 in March of 2009. The third time, a similar move from the low in March of 2020 to the present day. And we could have made the argument the market is way extended here, the market is extended here, and yet, from a longer-term perspective, good things continue to happen for a long period of time. Long period of time, in this case, is measured in years. Also noteworthy, a lot of volatility between this point A and this point B, and a lot of volatility between this point A and this point B. And this move from here in March of this year to this point here aligns with all of the information and data that we covered off of the March 23rd low in the U.S. stock market. These rate of change moves here are based on human behavior, and we have very similar and rare and sharp moves in factory data. Here's the low, 2008, 2009 factory data. Very, very similar to the sharp move that we're experiencing in the present day. We all know it's always important to keep an open mind about a wide range of outcomes, including worse than expected outcomes and the possibility of a correction in Q1 of 2021. Thus, from a money management perspective, it's always important to have worse than expected guideposts. The daily chart of the S&P 500 index dated January 21st, 2021. This is the vaccine Monday high here. This is the October low before the U.S. election. This is the high that was made in early September of 2020. You can see we were in somewhat of a trend channel here, and now we've broken above that trend channel. If we move backwards from these levels here, this represents an area of possible support at 36.46 and the September high at 35.88, shown by this thin blue line here, would be relevant as well. Notice we're saying possible support. We're not assuming that anything is going to hold. And these levels tie in nicely with the hypothetical maximum one-year drawdowns that we covered in a recent video. You can find more information about this chart by Googling this title here. Historically, after we saw similar signals, the market tended to have very, very shallow pullbacks. So far, we haven't done anything that's out of the historical norm. Historically, most of the drawdowns were clustered in this area here and tended to be relatively shallow. There were maybe 3 exceptions. This gray line here would take us back hypothetically to the vaccine high. This black line here would take us back hypothetically to the September high. Worst case scenario, this teal line here would undercut that level slightly. But in all cases, we would still hold well above an upward sloping 200-day moving average shown in red. If we exceed these levels or drop below the 200-day moving average, we would learn something about increasing bearish probabilities. But any pullback to these levels here, in terms of history, would fall into the 100% normal and to be expected category. And from a timing perspective, these type of maximum drawdowns tended to occur relatively quickly. In the present day, that would equate to maybe mid to late February for a drawdown low. It's also interesting to note, remember we said the Global Dow really didn't look too confidence-inspiring at the end of October. The S&P 500 was also struggling at the end of October. Slope of the S&P 500's 200-day moving average at the end of October, completely flat and indecisive. In the present day, trying to turn up in a bullish manner, which would tell us that the long-term trend is trying to turn up in a bullish manner. And in terms of the bigger picture, we could show numerous charts like this. We really haven't seen anything yet as of Friday's session. This is 10:39 a.m. Eastern Time that would throw up major yellow or red flags. This is high-yield bonds relative to treasuries. We have somewhat of a stalled look here. However, this ratio made a new high for the rally off of the March low on Thursday of this week, so not even one full trading session ago. This is worth watching, but at this point, with this new high on Thursday, it's hard to say this is jumping up and down saying be careful. That may change, but it hasn't changed yet. Now let's cover some subtle shifts that could have serious long-term implications for investors of all ages. So long-term monthly chart of the S&P 500 index stocks relative to long-term treasury bonds. S&P 500 divided by the price of a 30-year U.S. Treasury bond. Similar concepts here, but this looks more like the breakout that occurred in the S&P 500 index in 2013, and a little bit like what just happened in the Global Dow. This looks like a bullish breakout, then a failed breakout, and a sharp reversal to a new high. This is a period of indecisiveness where the stock-bond ratio can't decide if it wants to hold above this high, and this high from the year 2000. The look of this chart on January 21st, 2021 also aligns with the look of the S&P 500's longer-term chart. Down here, Earlier in 2020, the look of that chart for the most part contradicted the secular trend thesis. Stock-bond ratio, point to point, went absolutely positively nowhere for 21 years. This is a long-term period of confusion and indecisiveness. And this long-term period of confusion and indecisiveness looks radically different from this secular trend that occurred from 1982 to the year 2000. We all know the expression, the market needs to consolidate its gains. And after consolidation and a bullish breakout, we also know that the prior trend tends to resume. That is true on a daily chart, a 60-minute chart, and a monthly chart going all the way back to 1978. And once again, I might add, we are not cherry picking, we're looking at all the data that we have going back to 1978. This bullish breakout here, which is now holding above this long-term consolidation box, tells us we should be open to a secular trend starting. Upper right-hand corner of your screen, that looks similar to this period here from 1982 to 2000. Recency bias can affect us on a 1-minute chart, a 60-minute chart, and a multiple year chart. And recency bias may be telling numerous human beings that this chart here, before a new bull market can start, has to come all the way down to the bottom of this box. Because that's what happened here in 2002, and that's what happened in 2009. Market history says that is not true, and that is a dangerous way to think at this point, especially with a bullish breakout in hand as we have today. The other thing that's happened inside of this box here that starts in the mid-1990s, a balanced portfolio worked extremely well inside of this box. Now that we have a bullish breakout, we have multiple years of history that tell us it could be very, very dangerous to believe that a balanced portfolio will perform the same way over the next 10 to 15 years as it did over the last 10 to 15 years. Like everything else, that's a probabilistic statement based on the chart in front of us. And this very long-term period of indecisiveness has also created all types of asset allocation bias and pie chart bias. It's very, very easy to look back from here and think that you can build the perfect pie chart. Typically, when you think you have the perfect pie chart, guess what the stock market does and the asset markets do? They change. Anyone that's studied markets and asset allocation for a long time, they know there's no such thing as a perfect pie chart that works under all conditions. If we see something like this, there are going to be a lot of pie chart investors that are very, very disappointed 10 to 15 years down the road. So what this ratio is telling you here is it was pretty much an even match in here between stocks and bonds. That's discernibly different from this period here from A to B, where stocks absolutely annihilated bonds. Between point A and point B, the end of 1981 to the peak of the stock market in the March of 2000, price of a 30-year Treasury bond went up 95%. The S&P 500 gained 1,146%. Thus, hypothetically, based on the ratio in front of us, if we were invested in 100% bonds, 0% stocks, from roughly 1982 to the year 2000, that portfolio would have returned approximately 95%. 50-50 mix between stocks and bonds, the traditional balanced portfolio, 621%. 100% stock portfolio, 1,146%. Not a prediction in any shape, form, or fashion. This is the chart in front of us. It's nearly impossible, using technical analysis, to say that this chart is not leaning favorably for stocks relative to bonds on multiple time frames. This is a multiple year consolidation and a bullish breakout. This is a consolidation box that started all the way back in the mid-1990s, a bullish breakout, what appeared to be a failed breakout, but now looks like a successful retest and a higher high. We know the longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. Thus, the longer this breakout holds and the longer we have a higher high above the 2018 high, the more relevant it becomes. Thus, based on all the charts and data that we've been looking at this week, not much has really changed since we put these bullet points together in early January. The big picture unquestionably remains constructive. Correction in Q1 would not be shocking. 1995 tells us we can't assume anything. We can't guess that a correction is coming. If you did that in 1995, it didn't work out particularly well. As always, we have to remain open to a wide range of outcomes, from wildly bullish to wildly bearish. And that applies to very short-term time frames all the way out to very long-term time frames. The maximum drawdowns that we've covered previously tell us from the recent high on January 21st would not be shocking to see the S&P 500 pull back roughly 5%. In worst case scenario, we could get close to a 10% correction, and even under that scenario, we would stay well above an upward sloping 200-day moving average. Most of the drawdowns historically tended to be relatively muted and would keep us above the 50-day moving average if they occurred in the short run. In terms of the timing on a possible pullback, we mentioned earlier mid to late February, and that also aligns well with some seasonal items covered here by Ryan Dietrich. Thus, when you ask the question, is the stock market due for a change in character? From a shorter-term perspective, most people would say yes, it needs to fall. I think you can make an argument based on what we're seeing in the present day. This is very, very similar to 1995. And based on this convincing look in the stock-bond ratio, and based on this recent bullish breakout in the Global Dow that tends to confirm this significant and long-term breakout in 2013 in the S&P 500, we can make a sound argument that the answer to this question could end up being yes. And the change of character may be a much stronger and secular-like bullish trend. This date here is similar to something that we just saw from a breadth perspective in the present day. This is what happened after that in the subsequent years in the S&P 500. If we put the 200-day moving average on this chart, this would be a significant change in character relative to what we've seen over the past 2 to 3 years in the S&P 500, where we've been bobbing up and down above and below a 200-day moving average that tended to be more flattish and confused. This is a strong secular trend look, and it's quite possible that the S&P 500 might not go back and tag its 200-day moving average for several months. In the 1995 case, it didn't happen until calendar year 1996 in the month of July. And how could the market continue to push higher? If we started to get some consistently good data on the virus relative to what's been consistently bad data in recent weeks and months, that might help. As always, in these videos, we're making probabilistic statements based on the facts that we have in hand. If the facts change in a meaningful way, then we have to reassess those probabilities. We all know the only way that we can do all of this effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Ciovacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.